Hello guys, you are welcome back to my YouTube channel. My name is Dr. Harmonix, your favorite mentor. If this is your first time coming to this channel, don't forget to subscribe, click on the notification bell so that you'll be notified when I upload my next video. Let's be very candid over here. At every point in time, traders will always take a position at the wrong side of the market. That is why stop loss, which is your invalidation price, is very important when placing a trade. That is why in this video, I'm going to show you exactly 4 big mistakes that traders or beginners make when placing a stop loss. Now, the first one is traders set their stop loss very tight. Traders in setting their stop loss tend to set their stop loss tighter than their leather pants. They are so tight that there ain't room to breathe. In placing ultra tight stop loss, there won't be enough breathing room for price to fluctuate before going their way. Now, always take into consideration the volatility of the market and the fact that price could dilly-dally around your entry price for a bit before continuing to price direction. Let me show you an example on the chart. Now, on this chart, you have pound JPY. You can see that you are expected to, the price is expected to sell after the breakout of this trend. Now, you anticipate that the market is going to sell. However, you shouldn't set your stop loss very close to this entry. You should give it a breathing space above your resistance level here and give price room for more volatility so that it will eventually sell when it's supposed to sell. Don't put your stop loss very tight to your entry because price can go and hit your stop loss before eventually going down to your direction. The second mistake that traders make is by using position size like X number of pips or I want to lose $5 for every trade. The market doesn't work like that. You have to set your stop loss based on technical analysis. That is why you need to learn your technical analysis very well to know where to place a trade. Let's move to the chart and let me show you how it works. Now, when you are placing a trade, let's say the pound JPY, and you want to sell this pair, what you are going to do is that you don't tell yourself that you want to lose only $500 when you have $10,000. So you want to set your stop loss very tight so that when you lose 500. Your stop loss should be based on your support and resistance level. That means that this was your previous support. This was your previous resistance. So you want to set your stop loss above the resistance and watch trade move down to your direction. You want the trade move down to your direction here. You don't want to set stop loss very tight over here because you've made a rule for yourself that you should not lose more than 2%, you should not lose more than 20 pips, or you should not lose $500. So any stop loss that will make you lose $500, that's where you put your stop loss. However, you should set your stop loss first before you calculate your loss size. So your entry price and your stop loss will tell you the loss size you should use to place the trade, so that when you lose, you are going to lose exactly how much you want to lose on the market, not setting your stop loss based on the number of pips or the number or the amount that you want to lose. You should set it based on your resistance and support level. Now, the third mistake traders make when setting their stop loss is by setting their stop loss too wide or too tight. Now, as a trader, why would you move your stop loss too far or too wide from your entry price? Why would you continue to keep losing trade when you can channel that money into another trade to make profit? Don't set your stop loss too wide or too tight from your entry, because when you do that, you increase the risk that you are placing on that trade. It is better to cut your trade short and channel that money into another trade to make it up for the losses that you incurred on your losing trade. Now, on this chart, you realize that AUD/JPY, we're expecting price to actually fall. Now, if you go and set your stop loss too wide or far from your entry price, it will increase the risk that you place on this trade. Now, when you check this trade, the distance between the entry and the stop loss is the same as the distance between your entry and your first take profit. It is better to reduce the distance between your entry price and your stop loss, so that it gives you a very good risk to reward ratio when you are placing the trade. The fourth mistake that traders make when setting their stop loss is setting their stop loss on exactly the support and resistance level. Now, when you are placing a trade, you should always look for your major support and resistance level. However, you should place your stop loss below the support and above the resistance level when you are placing a trade. Do not place the trade exactly on the support or the resistance level. Let's move to the chart so that I'll explain to you how it's done. Now, on this chart, we are expecting DXY, the dollar index, to move up. However, it has not broken the trend line. We are expecting that when it breaks the trend line and gets to this yellow line, we should buy. When you are placing the stop loss, this would then be your support level. So you should not put your stop loss on this support level when it breaks. However, you should give it a breathing space, let's say this point, so that it will take into consideration the volatility involved, and place the stop loss below the support level for a perfect entry. It is not good to actually place the stop loss exactly at the support level. This is all I have for you. If you love the video, don't forget to subscribe to the channel. Don't forget to click on the notification bell so that you'll be notified when I upload my next video. As usual, my name is Dr. Harmonics and will always be your favorite mentor. See you in the next video.